Good afternoon and welcome to another edition of the RCLCO Monthly Roundup. When we started these last March as weekly webinars, I think we might have to do them for a bit. They quickly became monthly webinars, and now I don't think any of us believe we'd be sitting here introducing a one-year look back, but sure enough, here we are a year later. We know the last 12 months have been difficult for many of our friends, family, and colleagues, and on behalf of the RCLCO team, I want to send our best to all of you. And with vaccine rollout here, it does feel like there's a light at the end of the tunnel, so keep hanging in there. We also want to thank you. Part of the reason we're still here a year later is that you, our loyal audience, keep tuning in, coming back, telling us that we're providing value and insight and helpful and informative information. That's our goal here at RCLCO, so it's great for us to hear that. With that in mind, let's turn our attention to today. A friendly reminder, I'm Joshua Boren, I'm Managing Director here at RCLCO. I'll be moderating today's discussion as we look back on the past year under these unique circumstances. Joining me is Managing Director Charlie Hewlett and Director of Strategy and Research, Bill Maher. Charlie and Bill joined us back in January when we shared the RCLCO point of view in our semi-annual sentiment survey results. Last month, we took a break from our normal webinars to debut our interactive dashboard tools around second home and vacation rental and our survey there, all of which is available on our website, of course. Today, we're going to touch on the following, though. We're going to look back through the lens of the last year and everything that's happened with COVID. We're going to look at trends and impacts on the economy, capital, and real estate markets. And after Bill and Charlie walk us through all that, we're going to utilize the remainder of our time for Q&A. So with that in mind, please be sure to keep sending in your questions throughout the discussion. The Q&A will be open. If we don't get to them while we're on topic, we'll come back at the end and try to ensure we get time to tackle all the hard-hitting questions here over the last year that you guys have had for us. With that in mind, one last reminder that you don't have to take any notes here. Everything is recorded. We'll be publishing these on our website as well and disseminating the slides or the webinar out afterward. But you can, of course, again, find all of this on our website. So with that, thanks again for joining us, and I'll hand things over here to Charlie. Kick us off.
All right, thanks very much, Josh. Yeah, so we're going to jump in. We'll go through this stuff pretty quickly. A lot of it, I'm sure some of our audience is very familiar with, and try to get to the Q&A as quickly as we can. So we were saying, 3-4 months ago, it's not the economy, stupid, it's the curve. And we were talking, of course, about, new cases and the deaths, and that was really the determinant of the trajectory of the economy. I think that's changed a little bit now. It's not the economy, stupid, now it's the shots. So it's all about getting to herd immunity and rolling out the vaccines, which are ramping up quite significantly. There is, of course, a risk when you look at what's going on in Europe in particular, now facing a third wave and some of the problems they're having with vaccines there. So I don't think we're out of the woods, but I think we're headed in a good direction. When you look across the country, of course, the rollout rates and the cases of per 100 individuals or per 100,000 varies significantly. And so I think that this really speaks to why the recovery is still going to be a little bit of a patchwork and may take some time, because the whole country is not moving necessarily in unison. Again, moving all in the right direction, but it may take a little bit of time for different areas to get fully opened up. The stimulus, of course, the American Rescue Plan, huge numbers, and as you look at the, all of the billions of dollars that have been flooded to prop up the economy, this is all, I think, good news from an economic standpoint, from a real estate market perspective. We're looking at what happened in terms of the office market and physical occupancy rates across the country, and obviously dropped off precipitously at the beginning of the pandemic and really kind of is flatlined at 30-40%, depending upon where you are in the country. And so I think it's going to take a little bit more movement towards herd immunity in order for people to feel comfortable going back to their place of work. And it may be that these numbers are going to be somewhat depressed going forward as we have more work from anywhere as part of the American workforce. When you look at, we look at some of these unconventional metrics, beyond employment growth and GDP and things that are lagging. And, so we look at automobile traffic impacts over the last year, and you can see that the year-over-year change, has been very dramatic and varied quite significantly depending upon where you are in the country. Let me turn it over to Bill quickly to talk about some economic and capital markets factors.
Yeah, thanks, Charlie. In advance, maybe if things go wrong with my audio or video, I was on a NCREIF webinar yesterday, and someone said the main reason they want to go back to their office is to have good internet, and I can agree with that. I'm in a rental home in Florida right now, and at sometime around mid-afternoon, it seems like the whole all of Florida is on the internet. It slows things down. So if I cut out a little bit, I usually get back at some point. All right, let's look at the U.S. economy, and Charlie mentioned the American Recovery Plan. This is a forecast from Oxford Economics, and they think that that ARP will add about 3% to the growth in 2021 this year, getting up to a 7%. So that's a tremendous GDP growth. Part of it's the stimulus, but part of it's all the pent-up demand that will flow back in when the COVID-related restrictions are lifted. And the 7%, that actually may be light. There are some forecasters out there going as high as 10% for 2021, a number we've not seen in a century really.
And Bill, for context, right? Won't that be the highest GDP growth since the 1980s?
The 7% will be, and if it gets to 8%, will be the highest since the 50s. So big numbers.
Yep.
Going. Yeah, but that's the GDP number. All good. The job numbers have been less robust. As you can see, that the initial impact of COVID was 22 million jobs lost. We came back really strong for about 5 or 6 months, but we slowed a lot starting in November of last year. Had a good month in February, 379,000, but we're on pace. The forecast is to create 7 million or to get back 7 million jobs this year. So we need some really big months going forward. We think that will happen as the recovery unfolds. But right now we've been in a little bit of lull in the job side. And then unemployment rate is come down nicely to 6.2%. You can see it's below the average of prior recessions. But that's a misleading number. There are a lot of people that are underemployed or have left the workforce. I think a lot of people think that the true unemployment is as high as 10% now, and so we really need to create some jobs and some better full-time jobs. So I think that's why the stimulus has been so high. We've talked in past sessions about the K-shaped recovery. Here's a look at it just in terms of high wage, middle wage, and low wage jobs in terms of the employment recovery. So high wage, the number of people with so-called high wage jobs over 60,000 is about flat from where it was in January, and then a year ago. And then the low wage is 28%. So it's a lot of the service workers, retail workers, hospital lodging workers. That's where the pain still exists. So again, the stimulus package was meant to hit that broadly.
And Bill, we have a question, if I can just jump in real quick, since we're talking about it. But with the projected, somebody's asked, with the projected GDP growth of 8 to 10%, 7 to 10%, and historically low interest rates, is it that we're really just borrowing home sales from the future? That's the question.
We'll have a couple charts and discussion on home sales down later on. So why don't we'll keep that question in mind.
Right.
Let's move on from there. Charlie talked about the uneven recovery, and it's been an uneven impact. What this chart is, the map is the cities in red are the top 10 MSAs for job loss, and the ones in yellow are the ones with the least job loss. And you can see like Austin is down only 1% from a year ago, so barely unchanged. And then there's some trends you're seeing here. So the tourism cities such as Las Vegas and Orlando clearly hit hard. People just can't travel there. A few of the Rust Belt cities such as Detroit and Cleveland and Rochester. But the ones that really concern and real estate investors are the ones that have really been hit hard are some of the gateway markets such as Boston, New York, LA, San Francisco, and then even Portland, sort of an up and coming tech market. So I think that the Sun Belt and the sort of Sun Belt north of Kansas City and Indianapolis, those are the places that will probably have the best housing demand, best retail demand, will look the best. The other markets, particularly the gateway markets, have, you might see more distress there, so potential investment opportunity. But I think that those markets will really need to, do something about the fact that they're viewed as high cost areas, and work on the quality of life. So I'll mention that a little bit later. Retail sales, there's lots of ways to look at retail sales. The month over month number just came out a couple of days ago. It was -3% in February versus January. Turned out January was a great month. It just got revised up, so it's not surprising that it came down. What we're looking at is these months are versus the same month a year prior. It's a little bit better way, we think, of looking at it. So we saw the big hit in March, April, May, down, but it's been pretty good numbers overall retail sales since sort of summer of last year, and we're still 5.5% overall versus February of 2020. So retail's been overall pretty good, but look to the right, and it's really been a tale of two cities, with food service, apparel down a lot, department stores down, grocery stores are up 11%, and non-store retailers, e-commerce up 22%. I think that's the big issue, is that the e-commerce has taken so much market share. I think it'll give some of it back, but it still has been a boost that will help them in the long run. So keep that in mind. We'll talk about that when we talk about retail. Another sort of indicator of the two different types of recoveries going on. Large firms are very confident. They think they're doing fine with COVID and with Zoom and work from home. The small firms, they're the retail shops, the service firms. They're not that confident. They're not. They have a long way to go. In fact, they've been getting worse over the last few months. So with all this growth in the system, and likely to occur in this year, there's certainly been some concerns about inflation. This is one measure. It's the TIPS market that gives an indicator of what the next 10 years of inflation looks like. And it's gone up a lot in the last several months. It got down to the market forecast being only 0.5%, and that's for a 10-year period. That was when COVID was at its worst. Now it's spiked up to 2.3%. It's high. It's higher than it's been, but it's certainly still not that dire. And let's look at the next slide. And again, this is back to something that Oxford's put out, which is saying that there's some fundamental reasons, particularly the rise in energy prices, that will lead to some numbers close to 3, maybe even 3.5% on a monthly basis for inflation. Their view, and I think most people's view, is that that'll be temporary. It will, inflation will stay tame. The Federal Reserve is saying that as well. But there could be some turmoil in the bond markets in middle of this year as we see some 3 to 3.5% headline inflation numbers. And with inflation comes interest rates, and certainly interest rates have been rising. The number I think today is about 1.7%. So we're actually higher than we were a year ago. It was extremely low. Let's go to the next slide. And just putting the last year in context, I think there's a bill.
Yeah.
Putting the last year in context, you can see that we've been in an abnormally low interest rate environment, really helped by very low rates around the world that keep the U.S. rates low. But with a healthy growth environment, we really can't expect to be in the 1 to 1.5% range. I think that the normal would be more in the 2 to 3% range. So I wouldn't be surprised. The market loves low interest rates, but if you're growing your economy, in the long term at 2 to 3%, I don't think they can be that low. So
and of course the interest rates are one of the key determinants in the for sale housing market, which was one of the questions that we had. So it's already beginning to put a little bit of a damper on some of the torrid sales that we saw early on, right?
Right. Although a good economy and job growth and the demographics are really beneficial to the housing market. But we'll talk about that in a bit. Look, this is looking at the different sectors. Another look at that. Let's focus on the orange bars on the right. Pretty much all sectors had some recovery or some growth in the fourth quarter of 2020. The exception being government, which is being hurt by reduced revenues and higher costs. So they've had on an aggregate some layoffs in the fourth quarter. But you can see that the red bars on the left are the prior 3 quarters, the first 3 quarters of 2020, and some really big numbers, particularly in hospitality. We cut off the chart, but it's hospitality and leisure and hospitality employment fell 22%. So a long way to recover. I think that we'll get there partly when the hotels and reopen and travel starts, which I think will probably be third quarter of this year. So it'll come back, but a long way to go, and as do all these other sectors. The stock market's given us some interesting information. So this is for the whole of 2020. You can see that tech has been the darling, up 49% so over the year. So kudos to the big tech companies who have really done really well in terms of growing their business. The overall market, the S&P 500, up 18%, again anticipating the recovery. We do have to look at real estate though, and the REIT market is actually down 4% since the beginning of last year. So really not as much recovery. It makes sense because retail and hotels were pretty much shut down for much of that time period. And then we had some excitement to the stock market. Wall Street Bets is creating all this frenzied buying going against the shorts. The minimum versus the maximum for GameStop over this time frame is 11,000% high versus low. So incredible volatility. And then AMC, which is the theater company, it's a REIT. It only had 900% of high versus low. So a lot of volatility that I don't know. Maybe this is something we'll have to live with, but you certainly wouldn't want your stock to be subject to this kind of ups and downs.
And Bill, I think we say many times that the stock market is not the economy, but do you expect this to be a trend going forward in the markets with a lot of volatility and trading for sort of the little guys against the big hedge funds, or is this just a one-off deal?
I think it will continue, but it doesn't move the market because it's a handful of stocks at any one time, which doesn't really make any difference in the big numbers.
All right, great. Well, let's talk a little bit about the real estate sectors. So one of the things that we do, probably everyone knows, is that we do twice a year we do a sentiment survey among real estate market participants as an indication of what both the current sentiment is with regard to the health of the economy and the real estate markets, as well as what the future forecast is. And you can see in our mid 2020, the index was sub 10, which was the lowest that we have ever recorded going back to mid 2011. We started this, after the great financial crisis. So it would have been interesting to see what people were saying mid 2008. But, needless to say, this just represents, a terrible current sentiment. At the time, the expectations of the future were better. And I think the sentiment has recovered, quite smartly to about 32, and even better news that the sentiment going forward is, probably sitting there at about 70. We would say that anything kind of north of 50 or 60 represents good economic time. So we think that the future expectations are fairly positive and robust for real estate. When you look at the history of what happened in various sectors, you can see the bottom part is the change since the fourth quarter of 2019 compared to Q1 of 2021, and there's been some I think some significant recovery in a lot of these metrics, but you still see the office market and retail lagging behind multifamily and in industrial, which probably isn't a surprise. Net absorption of retail and of office, even still in the first quarter of 2021, still in negative territory, and rent growth still declining. So, those are two areas that I think will take longer to recover and are worthy of keeping close tabs on. When you look at the change in NOI, this happens to be the NCREIF index for all private real estate open-ended funds for all property types. You see the drop in NOI was just precipitous and much greater than it was back in 2009 and 10. So pretty dramatic impact on real estate in general. But again, it was fairly concentrated, interestingly, in retail in particular, and then to some extent in the apartment market. And I think part of what's happening here is that because we get almost daily pricing, if you will, annual lease in the apartment sector versus long-term leases in some of the other commercial real estate sectors, the apartment market has the ability to reset itself more quickly in the marketplace, and a lot of this was reducing rents to buy occupancy. We expect.
Charlie, a lot of the apartments in that index are in those gateway markets that got hit the hardest with job loss. So, your San Francisco, New York, and DC rents are down a lot, and that's a lot of the properties are in those markets.
Agreed. Home ownership rate. So there was kind of an interesting spike in January, up to 67.9%. The Census Bureau put out some guidance that maybe this was an error given the sampling methodology. They actually didn't have people out there knocking on doors for the monthly survey, but we're relying on different methodology. And I think personally, I think it is a little bit of an aberration statistically. I think you can probably connect the two dots here, and that's probably the correct trend. So I think the direction that we have seen, since Q2 of 2016 is correct. Bill talked about, demographics. We always say that, demographics is destiny. And as we look at, the older cohort of millennials entering home ownership, I mean, this is not surprising, and is a lot of it is demographically driven. But I think in the pandemic, certainly you see a lot of millennial households that had intended to buy were forced off the fence, by the need for more space, the willingness to move out of urban locations, and essentially free money. So the question earlier was, have we borrowed some sales from the future? I think it's possible, but when you look at a longer term trend over the next 2 to 3 years, I would default back to demographics or destiny, and know that home ownership is probably going to be on the rise just purely by demographics. Now, some of that's going to be influenced by interest rates, as we've talked about. We expect them to be low for the foreseeable future, so that's positive. But you look at what's been happening, and we'll talk a little bit later about construction prices and the inventory, particularly of existing homes. There's been sort of a logjam in the market where there just hasn't been available inventory, and prices have been escalating. We expect all of that to moderate and for that to loosen up. I don't expect to get back to 2004 kind of levels of home ownership in the country. That was a fiction of the great financial crisis, but elevated rates in the 65% is probably the right trading range for home ownership in the country. So here's again the look at the national home sales. Crashed early in the pandemic and then came roaring back, has cooled off somewhat just in the last couple of months, and probably will be bouncing around at these levels. Interesting to see that the existing home sales kind of getting back to the pre-great financial crisis period. Again, I think driven largely by low interest rates. We talked about construction costs. I think everyone going into the latest downturn, we're hoping and expecting that construction costs would come down or at least go sideways. That did not happen. And in fact, if you look on the far right, lumber prices in particular has been a conundrum for both home builders and folks in the multifamily space. And so that has been a real challenge, making a lot of these new deals pencil and driving prices and availability of new homes. in the marketplace. So Bill, let me turn back to you and you can talk a little bit about the capital markets.
Sure, thanks. Yeah, so this just shows transaction volumes from RCA. Many people look at this. The decline for all transactions from 2019 to 20 was a decline of 41%. So on paper, it looks like a really big drop. But 2020 at $335 billion, really not that bad a year. Certainly nothing like the global financial crisis. And in fact, the third quarter to fourth quarter was a pretty big rise. So we're on a pretty good trend. We think that that it will come back pretty nicely. And I think that there is plenty of capital. There will be plenty of transactions, broadly speaking. If you look to the right, you can see that it does vary by property type, the decline. Hotel and retail down the most, and office was pretty close. So those were the ones where there was uncertainty. But I think you'll see transactions in those areas as well. Let's keep moving on. One of the reasons there's a lot of dry powder, real estate, despite its so-so performance in the public markets, is still viewed as one of the best places to get income, uncorrelated. We're seeing more institutions increase their allocation to real estate and very few decrease it. So there continues to be money available that will keep that transaction volume healthy. Returns have been resilient. I think a year ago, a lot of people were saying that the NCREIF returns is the institutional private real estate returns would be negative this year, and some people thought they'd be more than 5% negative. They came in at 1.6%, a positive number. Over to the right, you can see that the forecast that folks that PREA comes up with is showing 3.8% for this year, 6.8, 6.9. So really getting back to kind of a normal run rate over this time frame. And you have to contrast that to the global financial crisis, where cumulatively almost 25% decline over those 2 years in total return. It really came down to capital and availability of capital. There was no capital available during the global financial crisis, and the Fed really flooded the markets with capital and prevented any kind of capital problems from dropping prices, and the low interest rates certainly helped as well. And then over to the right of the total, you can see the forecast by property type. Retail negative this year is the forecast, but back up to 5 to 6%, not too bad. And then industrial is the star, which it has been for really 5 or 6 years. So both the rent growth and the cap rate compression continuing in industrial.
And Bill, I wonder out loud whether these PREA consensus forecasts were driven before the stimulus was passed. I mean, I would think about the stimulus getting in the hands of consumers. Do we think that the retail numbers might be more robust in 2021?
No, this actually was done in February or January, February. So I think it was pretty much given that there'd be something, but I think there's just problems. There's a lot of malls in the retail numbers, so I think that there's still concerns about malls. I agree with you that particularly the supermarket anchored centers, the supermarkets have been fine, but the ancillary space has been shut or had problems. That will all reopen and probably will do fine, but I think the malls are dragging this number down. Interesting what happened in the REIT sector. An immediate, the big decline, particularly in some property types. So got this into 3 phases. The first 3 months of 2020, the overall index went down 27%, with retail down 49%, lodging down 51%. So a very, sort of scared reaction to COVID and the fact that governments were shutting down retail properties, they were shutting down hotels, and it was just unclear how that would play out. Then in the next, after that, since March of 2020, been tremendous return in the sector, in the whole market and broadly. So, retail down 49%, up 69%. You know, the math of going down and up doesn't work in your favor. So over that total time frame, it's still down 14%. But really, you know, kind of, you know, not the sort of frenzy numbers that we saw early, but you know, probably more realistic right now in terms of the relative performance across these different property types. And then, you know, the other sort of indicator that we look at, actually we looked at lots of indicators, we've only put a few of these up, are, you know, we look at delinquency rates, special servicing rates. These are CMBS properties where there's good data available. And like all the other, you know, comments we've made, lodging and retail have been the problem childs, and the other property types have been really not much change. I would say that office tends to lag. Office has seen very little movement to special servicing or foreclosures or any problems. But office, you know, with long-term leases, you see the problems of usually a few years later than the rest of the property types. So we could see a little bit of move up in office. But again, it's these other property types where, you know, there will be some distressed sales and potentially some opportunities.
Yeah, and it really speaks to what we were hearing sort of early on, and particularly in multifamily, where everyone was hoping and expecting that there were going to be these great bargains, and they just never materialized.
Right.
Yeah. All right, great. Well, Josh, I know that you want to. Oh, I'm sorry.
I think we were going to do a quick summary, and then we're jumping into
Yeah.
Q&A. We have about 15 minutes left
we
here.
got some time. Yeah. So just to wrap up what you've heard from Charlie and myself. The COVID impacts waning, good progress on the vaccines. You know, we're going to see some of the best GDP growth, I think, since the 1950s. So, you know, a banner year. Uneven job recovery so far. I think the ARP really does try to address some of that unevenness. We could see some inflation out of this massive stimulus and the resumption of demand and spending. Real estate recovery, we talked about the property types. I think there's plenty of capital. You know, and I just, you know, the second to last point there is the single family market, you know, both new, existing, single family for rent, we didn't touch on. You know, these are some of the strongest parts of the real estate market. So
yeah, we'll be touching on that in the Q&A because there's already a few questions about build to rent, as you can imagine. So, you
know, I think that the pandemic brought out this shift to the Sun Belt and low tax areas, low cost areas, and that will continue. And some of these big cities, these the gateway markets that really outperformed the last 15 or 20 years, I think they'll need to be creative in terms of amenities and attractiveness to people and to jobs. So we'll see which ones can do that better than others. Hey, Charlie, that's you know, we talked about these, but anything else you'd like to add?
Well, I think sort of keying off the last 2 points, you know, we've been spending a lot of time with our clients really thinking about their geographic deployment strategy. Been getting asked a lot of questions about, you know, gateway versus, you know, Sun Belt versus high quality of life. You know, the urban and suburban market divide is sort of a key question. And, you know, from the RCLCO shameless promotional department, we just dropped an advisory yesterday from my colleague Aaron and our business intelligence unit. And, you know, we think that this conversation about urban versus suburban is a little too simplistic. And to that end, RCLCO's created this place type framework that organizes submarkets and neighborhoods according to density and prevailing housing types at the census tract level, rather than relying on jurisdictional boundaries. So, you know, for example, when you think about places like, I don't know, Plano, Texas, or Reston, Virginia, Bellevue, Washington. So these are all very urban places, despite being classified as being in suburban counties. And likewise, there's some very big cities that have, you know, locations that are very suburban in character. So the RCLCO typology really, you know, puts these kinds of places within their context and helps you analyze, you know, metropolitan area trends and development patterns, I think at a level that, you know, sort of transcends just urban versus suburban. And there's this great tool that is now available on our website where anyone can go on and play with any metro area that they want and kind of look at what the trajectory has been, you know, at the level of these neighborhood sub category. So please go and check that out. But I know, Josh, that we want to get to some Q&A.
Yeah, no, but I think that was a good transition, Charlie. A lot of the Q&A, I think, is tied into a few kind of key trends that we've been hearing a lot over the year, things like suburban versus suburban. One of them being distress. Bill, you talk about transaction volume, you think coming back. I know that the bid-ask spread's been wide for some time now. I mean, has the distressed opportunity passed but yet all this capital was raised this past year for that opportunity, or where do we see that coming in terms of these different asset classes?
Yeah, I don't think it's passed. I think it's delayed because COVID is. I think the market consensus of COVID is a discrete, short-term problem. So I think that lenders and special servicers are waiting till that really plays out. But there's some long-term trends in retail, perhaps in full-service hotel if the international tourists don't come back in some of these gateway markets. So I think there will be some potential opportunities. They'll take a while. It's probably 12 to 24 months they'll play out, not immediately.
Yes, you played right into another similar question, which is somebody had mentioned the big lenders seem to be slow to react to those implied valuations, whether it's in the CBDs or in certain asset classes you just mentioned. So is there a pending glut of major write-downs heading our way 12 months from now, as you just said?
Again, I think it's a wait and see. I think the hope is that that all of these sort of lagging sectors and lagging cities will show some signs of life and recovery, and the write-downs won't need to be that big. But again, I think that makes sense because there's a chance it happens, and it's not that long. You have to wait to find out. But again, it comes down to, does New York City, the New York City hotels, recover to where they were? It's, they're really hit hard, and it comes down to both business and international travel going back to New York. So that's the unknown, and I think it's going to happen. It just may take a while, and lenders may not wait that out, but they may decide that it's probably better to let the owner work it out than for them to take it over and do a fire sale.
I think that's right. And I think the good news, bad news, as you saw in some of the charts in the public markets, with daily and hourly pricing, you saw the REITs crash and then come back pretty strongly. In the private sector, you don't have that kind of frequency of mark to market. And so, that pretend and extend, if you will, or waiting for the markets to come back, probably will keep a lot of assets in compliance and not force capitulation among potential sellers. So yeah, I think there's going to be some stress for sure, but I don't think there's going to be a tsunami coming.
I mean, some of the major mall companies have given some malls back. So you've seen it in the mall sector. You continue to see it there. Yeah, I mean, if anybody wants to buy a Class B or C mall, I think there's some really good bargains there if you have a solution.
Well, are they being sold as retail centers? Or are they being sold as redevelopment opportunities?
Yeah, repurposed industrial.
Probably the latter.
Right.
Yeah,
exactly. Well, and talking about darling, trends or sort of asset classes, we touched on single family rental, but I think, and we've heard from everybody, whether it's home builders, landowners, our apartment development clients. I mean, Charlie, you've been doing a lot of that work. What are we seeing there? Has it really been sort of following the trend we've been hearing, and thoughts just generally on where that's going?
yeah. I think this is a trend that has been building for the last 3 or 4 years, and really got a lot of attention just in the last year or so, particularly as there was some exodus out of urban centers and into more suburban locations, and out of multifamily into less dense single family rental, whether those are truly single family detached, scattered site or purpose built homes, or whether they are horizontal apartments, which are, essentially 1-story multifamily, but, look and breathe like conventional apartments. Back to the whole, demographics is destiny theme. This is a trend, as I said, it has been building. I think it will continue to grow. Our expectation is that this will become a significant subclass within the apartment sector. And we as a company are probably doing as many both site-specific strategies as well as company strategies on single-family rental, particularly in the build-to-rent space, as we have been doing multifamily, although they're both very, very strong. So, there's been a lot of interest from the capital markets and from, and from a lot of both public home builders, multifamily developers. So, I think we're just at the tip of the iceberg right now, but it's going to take just given the pent up demand and given the demand characteristics, it's going to take a long time for the development industry to oversaturate the market. I mean, yes, there may be some stress in certain locations. We're going to try real hard. Don't get me wrong, to overbuild, and we may be successful in some Sunbelt markets, but generally the demand characteristics are likely to outstrip our ability to deliver a single family rental.
So something like that, but also more generally outside single family rental, I think all asset classes, I guess. And then considering how many governmental programs have been going on with the stimulus and whatnot right now, somebody's asked, do you expect a market retraction after all those effects start to wear off? Given where we were before this, how does that play into what you're saying as well? Or do we just think it's robust growth from here going forward for a bit?
Yeah, I didn't touch on it, but that Oxford forecast had I can't remember the number, it was a pretty low growth number for 2023. I think it was sort of around 1%. So I think as those stimuli wear off, you do see a lower growth number, just the way the math works. And their view of long term, which I think is a long term of 1.7%, and most people sort of think it's about 2%. So the long term growth is lower than we're used to, but really what we experienced the last 20 or 25 years. But there could be that sort of as the stimuli go away, the numbers will be a little lower.
And maybe this is bigger picture, more macro for both of you guys, and you probably touched on things, but I'd love to get both of you to just tell us maybe your thoughts on what's the largest contrarian perspective you've had on what we've been hearing over the past year. The office is dead. Charlie, I know that's a big one of yours. You definitely don't believe that and are happy to get back in. You have a fake Zoom background of being in the office right now. What would you guys say is your contrarian perspective from some of the big trends we've heard in the last year?
Yeah, I think you touched on one for me. I think that while WFA, work from anywhere, was a trend that was growing pre-pandemic, was accelerated by it, and will continue and probably be accelerated post-pandemic. I think that the basic human desire and need to gather, collaborate, is too strong. As a company, I don't know how we effectively onboard new employees on Zoom. It just doesn't work. So I think those human nature tenets will conspire to have office and gathering locations be still a very important thing. And I know there's a debate. My other one would be the debate about urban centers and whether those are permanently damaged as locations. I believe that the characteristics that made high density urban places exciting and attractive for both employers and young people are going to be durable post pandemic. So to the extent that people think that our urban centers are going to empty out, I would say no.
Yeah, I would go back to something Charlie pointed out, which are these urbanized suburban areas. I think they'll have tremendous appeal, particularly to the baby boomers, but really the whole demographic spectrum. So I would continue to look at those, particularly if they have decent transit to the urban centers to get to the theater and the meetings and the things like that. So and I don't think that's contrarian, but it's something I really think will do well.
Yeah, I think that's fair. And to be honest, and we're just about out of time here, I think a lot of that is, and maybe this is the theme for the year, the big takeaways, a lot of this is what I think was already happening. And really the last year in COVID and whatnot has been an acceleration of existing trends versus new trends. I know RCLCO has been saying that for some time now. And would you say that's an accurate statement or is that fair?
Yeah, I think so. I think we'll look back and call this the great accelerant. The one maybe footnote into that, and Bill was talking it a little bit. I think retail, and particularly we have too much retail in the country, and we have obsolete retail. So I think that retail will continue to reinvent itself as it has from the beginning of time, but maybe on an accelerated basis.
Yeah, I agree as well. And I think that, COVID accelerates some trends. It also stops some trends. I think that things like the amenity wars for apartment buildings and, just some of the things that that made sense then aren't, I think will take a long time to come back or maybe never come back.
Yeah, well, I'm sure we can continue to talk about this. Unfortunately, we're out of time. I want to thank you both, Charlie and Bill, for participating and joining us. There were a slew of questions we didn't get to. Of course, our folks at RCLCO, including Charlie and Bill, are available for follow-up after if we have questions, so be sure to reach out. And again, this webinar will be available for you after as well if you have any additional questions. But thank you, and be sure to tune in again next month. We appreciate you joining us. Thanks, guys.
Thank you.